Good afternoon, everybody. I'd like to welcome you all to the Halftime Talk, a feature interview podcast. I'm delighted today to be joined by Mr. Stuart Broadley, who is the CEO of the Energy Industries Council based in the UK. Thanks so much for joining us, Stuart.
It's great to be here.
Great to have you. Well, supply chain is a big part of what your association deals with. Energy supply chain is the name of the game in our conversation here today. Of course, we're looking at the energy markets as part of our halftime talk. So let's talk a bit about that. Let's start with a bigger picture question for you. We have been through COVID. Most of the world has come out of it. Of course, one country that's still emerging from that is China, and it is a big supply chain center for many products. But let's just talk a little bit about the energy sector and its supply chain in terms of functionality across the world. A lot of challenges during COVID on supply chain in general. Where are we at today, Stuart, at the beginning of 2023? In general, with equipment, etc., that the sector requires, and have we emerged from sort of the COVID stresses, if you like?
Yeah, hi. It's good to see you all, and that's a good question, isn't it? So where are we today? Where will we be tomorrow? What I can tell you is, I suppose, that we do research called Survive and Thrive. It's done with EIC members, which we have more than 800 members around the world, as you rightly say. Mostly supply chain companies, although we do have some operators. Our supply chain members are all around the world, so they're very global, and they in all types of companies, from the very smallest sort of consultants and service companies like recruiters and legal firms, right up to the very largest manufacturers and EPCs. So when we do research with them, I think we do get quite a good touch point or pulse of what's happening right now and how supply chain companies are feeling. So that we're actually right in the middle of doing the 2023 research on that. As I say, we call it Survive and Thrive, which is talking about how the markets have been challenging. As you say, they were challenging through COVID. Actually, they were challenging right after the oil crisis of 2014, and they're still challenging now, but in different ways. The things we're finding right now are that actually most companies feel that they're coming into a stronger phase of growth. In fact, almost every company I've spoken to is feeling extremely positive about the current market conditions they're in. They're through the problems of COVID largely, so those shortages of materials, those very high price spikes have largely gone. Most prices have returned to pre-COVID levels, though that's still high. But still, the pricing of product is less of an issue, although it is still high. Now, the main issue with pricing right now is generally the cost of living increase, the inflationary pressures that people are feeling, and the challenge of passing those cost increases through to price increases to customers. That is definitely a challenge that we're seeing all around the world. And but companies are now accepting that price increases, sort of higher inflation environment is here to stay for at least the next sort of 2 to 3 years. And so they're realizing that they are going to have to start passing prices or cost increases through to their customers. But I'd say probably a couple of things that are real challenges currently. One is funding. So funding in some sectors is still a challenge, and it also depends a little bit on where you are in the world. So in the UK, for instance, if you're an oil and gas service provider or supply chain company, because of UK government basically regulations that restrict UK government from providing any support to oil and gas companies to do any kind of exports, also restricting funding to those companies. The high street banks themselves are also, unfortunately and sadly, finding it difficult to also provide funding for British supply chain companies. So this is not good, right? So I think the UK is the only country in the world which has provided this kind of restriction around its oil and gas supply chain. In the UK, if I just talk about that for a second, we have 3,500 companies in the energy supply chain, as defined as having more than £1 million of revenue, of which 3,000 of those 3,500 largely rely upon the oil and gas industry for their profits and revenues, although many are now diversified into other sectors like renewables. And so when you put restrictions on them to export, obviously that's not good. So I think that's one of the things we're hoping will soften as one of the consequences of, the sort of world we now live in, where oil and gas is so prevalent again, following the Russian invasion of Ukraine.
Yeah.
I guess we'll go on to talk about that soon. But
Yeah.
so I think funding is one of the issues, but the other one that we're seeing strongly is skill shortages. So right now we are not hearing any companies saying we are turning away work because we cannot get the people we need, or at least very slightly that's starting to happen. But almost every company I speak to is saying we're really worried about this year, next year, and whether or not we'll be able to get the technical skills we need to grow. And particularly because almost all companies are forecasting an oil boom. So it might feel like the oil industry is booming now, but most companies I talk to say their boom is to come.
And
So
I mean, and
that's
Stuart,
where they're worried about the skills. Yeah.
well, absolutely. And I wanted to get on to the skills question, actually, because that is part of, obviously, a critical part of the supply chain. And of course, as you said earlier about equipment and supply chain, that's not a new challenge for the industry generally. It's had its ups and downs in terms of retaining talent, attracting talent, the image of the oil and gas industry in general, and how that's changed with the pressures that have come on it from an environmental, ESG, etc. point of view. So on that talent front, for example, yes, you're saying in the UK, you're not seeing a lot of companies saying they're not being able to recruit the talent they need, but globally it is an issue. It is already an issue across the board. A lot of that technical talent is going into other sectors. What do you think the energy industry needs to do preemptively now to retain more of that talent? Is it a salary issue? Is it a reputational issue? And how much also does it need to train that talent for the sort of the transition part of the energy scope, if you like?
Yeah, I mean, to be clear, that the point I was making about skills shortage is global. It's not a UK issue only. The point I was making about the UK was more just the problem of getting funding, because around the world, generally, funding is becoming more available for oil and gas investments, as well as of course, the strong focus still on green. So yeah, I think if I go back to the Survive and Thrive research we're doing, where we're talking to companies about what are they doing to deal with this upcoming skill shortage that they're all predicting, they're all worried about. It's their number one focus area right now, as they all feel like they are growing as quickly now as they have ever done. Some saying it's record growth rates already. I'm talking about supply chain companies around the world. Because why is this happening? Because in a post-COVID world, almost all sectors and all regions are at growth, are as kind of a growth phase, rapid growth phase. And for a supply chain company right now, it feels like it's almost unlimited opportunities. I've actually never seen a market like this. I've been around a while now, and it's an incredible market. So yeah, supply chain companies all around the world are now faced with a challenge that they've not had for a while, which is picking the right opportunities to grow, and then ensuring that they recruit and retain the talent to deliver on those opportunities.
And
A number of companies, I
yeah,
was going to say, a number of companies I've spoken to are doing that by actually developing in-house training facilities, and to really kind of accepting that they can't just hire someone that has all the skills they need. And they're having to, bring them in perhaps at a more junior level than they previously would have done, a bit less experience than they previously would have done, and then to train them and to provide them with competence and assessment, and then, of course, to have a really broad range of employee benefits to then hope to retain them.
Yeah, and I mean, you mentioned about this is an unprecedented time, great opportunities for service providers, let's say, in that supply chain. Of course, one remnant sort of impact of COVID that's playing out now is, of course, China has always been a very big base for manufacturing companies to base some of their products, if you like, being made, even if they're sort of based in the UK. They get some stuff made in China, bring it back to the UK, and then export it, etc. A lot of big companies now, because of the whole China emerging story and how fast will it emerge, and just because the geopolitics of that, are relocating some of their bases away from China to other places in Asia, perhaps. How much is that relocation from old sort of trade centers, if you like, to new ones are we seeing, and do you see those as permanent?
I think there's a few factors in there. And so the simple answer is, yeah, I think we are seeing a permanent shift in the way people think about where the supply chain comes from and where their skills come from, and whether they offshore, onshore, nearshore, these different terminologies that are now being used for companies as they adapt. And it's not just about China, right? It's about actually the lessons learned from COVID, where companies found it was really hard. In fact, countries found it was really hard. If they didn't have the skills within their borders when the borders closed, they were in real trouble. So this has led to, you could call it a more protectionist approach by a lot of countries to say we need key skills, critical skills to be inside our country, and they're putting more regulations around in-country value and other forms of schemes in various countries around the world to kind of mandate that or strongly, incentivize that kind of behavior. So that, of course, makes it very hard for the supply chain, right? So if you're a company anywhere in the world who then say, I want to participate both in, UAE and Brazil and Australia and Malaysia, and increasingly, the operators are saying, well, we really need you to have more capability in country. We need you to invest in country if possible. Companies can't afford that, of course. So I think it's a kind of a sort of a push and pull scenario where in many ways the countries and the major operators are encouraging companies to come and invest in their countries, which feels like a great opportunity, doesn't it? Because if you do it, maybe you're sort of one of the few that's done it and you'll win more business. But yeah, companies, even though they're feeling like these are good times, that doesn't mean to say they have a lot of cash. So they're having to be very selective. And when it comes to then the decisions they then make about, okay, let's say I invest in 3 of those countries, but the rest I still do from my home base. Then, of course, they're then looking for, well, how do I then get cheap, good quality people so that I can make money in a high cost, high inflation environment? Margins are tight, even though the revenue lines are growing quickly. So they need to find ways to have very economic access to technical skills. And that is where then they are looking at, kind of as you imply, where are the lower cost, higher talented skill sets, pools of amazing people around the world. I was talking to a company just last week, for instance, who's opened up one of those hubs in Pakistan, for instance.
Yeah,
there's a great example of that. So I think countries now are much more open to, we need to go to where the skills are and where they're economically viable, and where they're loyal and technically brilliant people. And that opening up of sort of flexible approach to that, I think is a really good thing for world trade.
Yeah, and I mean, you mentioned ICB, where I sit here in the Gulf. That's a very big point made in terms of attracting people to set up here, and obviously offering the incentives for companies here. That's one of the big ones. You must hire local talent as well. You must use our local manufacturing base into your larger manufacturing base, if you like. Let me ask you, Stuart, about those sort of criteria that are now being applied to supply chains all over the world. You talked about funding in general earlier, and how strict are the ESG factors, if you like, being really actually implemented by the finance community when they look to fund any project or any supply chain company that may be feeding into this sector. Are we seeing strict enough ESG principles? Have they been put on the sidelines, if you like, with the whole energy security question now, and we must just make sure that everything's available? Where are we at these days with those?
So again, I'm doing this research at the moment, and I had a brilliant interview with a company. I won't name them because we haven't gone through the approval process of their story yet, but such a great example of, I think, what you're talking about, right? So this is a company who are predominantly set up to be a renewables centered business. They've been working hard to grow the renewables business for 6 or 7 years, and really felt very positive around COP26, where there was so much focus around, if you like, the pro-green sort of march that happened in coinciding with COVID. However, what they found was there was low or no margins in the renewable sector. This is language that I now hear everywhere, which is renewables is a market that everybody feels they want to be in, because sometimes it's a case of we really believe in it and it's our strategy. Other times it's because our shareholders demand it. And other times it's because perhaps a company's strategy laid it out as we need to have a share of our business that is renewable or green or hydrogen or whatever. But companies are increasingly finding that that's good from the point of view of branding, and it's good from the point of view perhaps of share price, but it's not good from the point of view of margins. And that's a very severe issue, right? So what companies are doing now, and this company I was talking about that I spoke to just recently, they are now, and backed up fully by their investors, right? Are almost investing exclusively in oil and gas, because the margins are so much higher, and using that money to then ensure that they can continue to grow their renewables top line. So this is a kind of a strange paradox now, right? Where if you want to acquire a company that's just an oil and gas company, the multiples are still pretty low, right? They're multiples of 5 or something. If you want to acquire a renewables company, the multiples are still high, maybe a multiple of 10 or 15. And yet all the money's in oil and gas and hardly any money's in renewables. Now, I'm simplifying, of course, I'm generalizing, but almost every conversation I've had with companies in the supply chain follows this same line. So if you extrapolate from this to where does it go? It goes to the situation where companies then, they need the money because a lot of companies have had a lot of debts built up over the years since the 2014 oil crisis, and then because of COVID. So they need to go follow the money, and so do the investors. And let's face it, so are governments right now needing to follow the money. I think oil and gas has regained its social license, but it's also the way that companies are earning the money they need to either invest in renewable growth, if that's what they choose to do, but also I think to look at then just returning to a sort of cash positive position generally.
Yeah, I mean, that is the whole yin and yang of it, isn't it? That, yes, oil and gas companies, of course, that helps their argument, doesn't it, to continue where the high margin production is. We need the money from that to invest in renewables, and you could argue about who and which of them are doing a better job of that genuinely.
Yeah, but if I could just jump in on that. So I'm not making the point here that it's always been said that companies that are in oil and gas need the money from oil and gas to invest in hydrogen and carbon capture.
They're making today themselves.
I'm not really making that point. I'm making the point that the renewable sector is a largely loss-making or very low margin industry, full stop. So it's not a case of companies needing the oil and gas to invest in new technology for hydrogen and carbon capture. That is still a good point. There's nothing wrong with that issue, that logic. I'm making the point that the huge mature renewable sector of onshore wind, offshore wind, solar, and hydropower, they are all largely loss-making industries. If you look at all the manufacturers of offshore wind farms, they are all, perhaps except in China, by the way, they're all loss-making. So that we have it's a major challenge in the whole sort of macroeconomic model of trying to grow renewables and expecting industry and governments to get behind renewables. If it's basically a loss-making industry, where does it go? It's not going to invest in future growth. And there are more than double the numbers of offshore wind turbines that are required to meet country pledges by 2030 than the current global supply chain can supply. So something's going to change.
Something's going to change, or governments have to cough up, I suppose, and take losses on their budgets, as they do for other causes. But yeah, you cannot expect the private sector certainly to continue to take that loss, and there has to be a solution. But yes, the transition is very much now being talked about as this is a transition. It's not an overnight solution. Let's talk about, Stuart, before we run out of time, let's talk a bit about geopolitics, reality on the ground. We have in Europe the challenge of the war in Ukraine, which of course has challenged certain supply chains in the last year, food being one of them. But of course, it's impacted prices of everything, including energy. And you mentioned costs at the beginning of our conversation. But again, is in terms of manufacturing companies, etc., the companies that your association represents, how much of a factor is that instability in Europe playing in their sort of economic planning, if at all?
So our members are global, right? So obviously members that are located in the Americas or located in APAC, largely they are unaffected by what's happening in Europe. I think most of them would say they're aware of what's happening, but they're not feeling the direct impact. Whether that's a good thing or a bad thing, you can take a view on. Inside Europe, of course, the Russian invasion of Ukraine is still having a major impact. It's destabilizing, it's worrying. And I think it's encouraging to see the governments, and that not just governments in Europe, but also governments around the world, are putting support towards Ukraine to help them, win this war. In terms of supply chain companies, of course, the main impact they see is what we've already touched on, which is that it's not so much shortages of materials anymore, but it is still, price increases for materials. If there is that kind of inflationary impact that's happening. But I'd say right now it's from a trade point of view, it's more stable when it comes to the impact of what's happening in Ukraine with the energy industry. In fact, I would say when I speak to companies, and I don't know whether this is something that people are talking about yet, but obviously longer term, the impact of a post-COVID world plus the combinations of tensions with US and China and tensions, Russia invading Ukraine and so on is a global recession. And I think they're sort of increasingly viewed that a recession is coming, the severity of it. People kind of have different views on. But most of the companies I speak to in the energy sector are using language now, which I think is surprising but interesting, which is they feel recession proof. So that gives you a sense. And this is kind of all over the world and including in Europe. And what do I mean by that? I mean that their view is that the energy industry is growing so quickly, and it is all sectors, all regions that are growing right now, through a decade or more of underinvestment in almost all sectors, plus a push for energy transition and the green revolution. You combine all that together, plus a shortage of gas because of the Russian invasion of Ukraine. Companies feel like there could be a major recession, triggered by a number of things, but their industry will probably be largely unaffected by that. And I think that's a kind of interesting kind of consequence that perhaps people haven't understood yet.
Yeah, and of course, I mean that demand, we have not peaked. Demand has not peaked yet, and of course there might be a recession in Europe, let's say, or a shadow one. Now people are arguing, but certainly, and that could happen anytime, obviously. But you've got, the growth engine is really Asia, isn't it? And so that's where we care more whether there's going to be a recession or growth for this particular industry, which is supplying. This supply chain you're talking about is mostly now exporting east. How much is that China reopening? We've had a lot of, we talk to people in the oil markets every day, and at the moment there's a lot of confusion about what's pulling things more, demand, supply, where's the price going to go, and which of those two factors is going to pull in. Really, everyone's saying we haven't got a clue. There's too many, so many unknowns. And of course, one of those unknowns is China. Yes, it's reopening, but again, what's the point of view from suppliers that is, again, it's kind of having a proper restart, putting COVID aside, it's economic policy changing, isn't it?
Yeah. First thing I must say about China is they've got to be applauded. Whatever your view on China, they've got to be applauded for the incredible growth of their renewable sector over the last decade or so. Just in the last 2 years, they've become the world's #1 producer of offshore wind by a factor of 3. A huge, production capacity they now have for offshore turbines, and I think that's a major challenge or threat to the sort of European and American offshore wind turbine and onshore wind turbine manufacturers that must be sitting there thinking, "Oh my God, China is coming." But if I think about the kind of overall impact of China, I don't think it's as big currently from an energy point of view as people think. I would say overall, what's interesting, and in fact, I see we have, of course, our own data on what we see as the sort of energy trends coming up, and so actually, it is a continuing trend, I would say, is what we're seeing with a recovery after COVID, where you get these two mixed messages, but they're kind of consistent when you sort of unpick them. The first one is that we're going to continue to see globally a huge number of projects announced, so quantity of projects announced that continue to be renewables and hydrogen and carbon capture. Mm-hmm. We are now seeing the number of hydrogen carbon capture, and if you want to call them the new transition technology projects, including energy storage, actually sort of tailing off. So the huge interest that happened at the start of COVID, which went up to 200 or more projects a year being announced in hydrogen just alone, that's now, we think, going to peak. Whereas renewables, as in kind of the mature renewable technologies of wind and solar and so on, they will continue to grow at a rapid rate. Meanwhile, the number of oil and gas projects, quantity-wise, will continue to stay low. Perhaps, only a quarter of the projects announced that you'll read in the press will still be kind of hydrocarbon-based. And this will continue to make people feel like oil and gas is declining. But you turn it around from a quantity point of view and look at it as a value point of view and as a profitability point of view, it's a totally different picture. And this is why I say what's happening in China is not going to have too much impact on what's happening as an energy sector globally, because the picture value-wise is that perhaps 2/3 of the value of the energy market for the next 5 to 10 years will be oil and gas, whereas it's less than 1/3 of the quantity. So it's going to feel like you're reading not much about oil and gas, and yet in the supply chain, everybody's involved in oil and gas, and they're all making money in oil and gas. And that's kind of where we're going to feel like we're reading one thing, but the behavior of companies is another, and it's because it's follow the money. And from the point of view of value of their transition technologies, it's still in the kind of sort of 5 to 10% range of the total world market. And don't forget, with the transition technologies, hydrogen, carbon capture, and so on, vast majority of those projects which have been announced are not funded, and many will not get to FID. And I think another thing I'd just like to finish on, which is again something I'm not reading anywhere else, and I think it's important that people understand this. When you look at these new technologies of hydrogen and carbon capture, they're incredibly exciting, and they do have a key role in the future. But and this is a big but, right now we are just 1, maybe 18 months away from new supply of projects completely overtaking any potential current or medium-term growth in demand for those projects. So we're just 12 to 18 months away from a crash, potentially, in those hydrogen carbon capture projects being funded because people realize there's no demand anymore. And how do we work that out? It's this basic idea that that there is a requirement for projects, of course, to have some kind of customer, some kind of off-taker. And the off-taker right now can only be the conversion of gray, if you want to call it hydrogen, into some kind of green or blue hydrogen. The longer term demand growth for hydrogen, is not going to happen in the next 5 years. It'll happen in the next 10 to 20 years. So I think as a total picture, overall, the energy industry is looking very strong. It's somewhat recession proof or very recession proof. The money's in oil and gas, even though companies still want the top line in renewables. You're going to read about renewables and hydrocarbons and hydrogen and carbon capture all the time, because that's still where the most project quantities are being announced, but that's not where the money is.
Well, that's a great place to stop. Stuart Broadley, CEO of Energy Industries Council, thanks so much for joining us. You mentioned the off-taker argument for the new energy technologies such as hydrogen. That is a big point of discussion that we have here in the Gulf as well, where we've seen a lot of investment into new hydrogen projects, and carbon capture is a very big one here as well. And of course, they have the funds and the means here to do it, but they are more long-term and not commercial yet. But thank you so much, Stuart Broadley, for joining us today on Halftime Talk. It's great to have had your
thank you.